$59.32. Silver just shattered every record in history. December 6th, 2025 today. But here's what caught my attention. While this was happening, JP Morgan reportedly moved approximately 169 million ounces into their vaults. Industry sources suggest this represents roughly 9% of global supply. They've been accumulating since 2011, 14 years, quietly. Now, I keep asking myself, if silver doesn't matter like so many experts claim, why would America's most powerful bank be hoarding this metal? My theory, something significant might be unfolding. And I want to walk you through a pattern I've been studying, one that's appeared in every major financial crisis in history, a pattern that's never failed. And right now, in my analysis, we might be watching it complete. In real time, you still have a choice. But let me show you why this window might be closing faster than you think. I'm not a financial advisor. This isn't financial advice, and I'm not affiliated with anyone mentioned in this video. This is purely educational analysis based on publicly available information. Look, I've spent months analyzing historical financial collapses. And what I found is this. They all follow a similar pattern. 4 stages, always. And here's what concerns me. Silver appears to be in stage 4 right now. Let me break down my thinking. Stage 1 is what I call the setup. Authorities create what looks like stability. Prices get suppressed. The market floods with paper promises. Everything seems fine. Everyone trusts the system. For silver, this started after what happened to the Hunt brothers back in 1980. Regulators got nervous about volatility, so they built something massive, a paper market that some analysts estimate is around 50 times larger than the physical market. Here's what really strikes me about this. According to published COMEX data, open interest sits at approximately 244% of vaulted silver. Think about that for a second. That means, and this is just basic math, if even half the paper holders demand actual delivery, the system could face serious stress. Stage 2 is about expansion. The gap between paper promises and physical reality expands. Debt, printing, promises stacked on promises, but prices still suppressed. In my view, we've been living in stage 2 since 2008. Reports indicate global central banks printed over $30 trillion. The US alone reportedly added around $8 trillion to its balance sheet. But silver didn't explode then. Why? My take on this. Every time physical demand increased, major banks reportedly flooded the market with paper contracts, short positions, derivatives. According to market data, prices stayed pinned below $30 for nearly a decade. Meanwhile, something interesting was happening with industrial demand. Solar panels need silver coating for conductivity. Electric vehicles require roughly 3 times more silver than traditional cars. 5G infrastructure, AI data centers, medical devices. Industry reports now suggest silver demand from industry represents approximately 59% of total consumption, up from around 40% just 10 years ago. And here's the part that concerns me most. Silver mine production hasn't kept pace. Data from mining reports show supply has declined roughly 7% since 2016. Analysts point to what they call a structural deficit. More silver consumed than mined for around 7 consecutive years. So where's the difference coming from? Above, ground stockpiles, vaults, reserves, they're being drained. India's silver imports reportedly hit record highs. China's been purchasing consistently, but paper prices stayed suppressed until recently. Now, this is where it gets really interesting to me. According to various market reports, since around April 2011, JP Morgan has accumulated what some analysts estimate at 675 million ounces of physical silver. If these estimates are accurate, that could represent roughly 45% of the world's above-ground supply in 1,000 bars. Let me put that in perspective. That's reportedly more than the Hunt brothers held at their peak, more than what Berkshire Hathaway ever held, more than entire nations. Why would they do this? Here's my understanding of what happened. Back in 2010, JP Morgan reportedly settled manipulation charges for around $200 million. When they acquired Bear Stearns in 2008, they inherited significant short positions. For years, they were apparently on the wrong side of the trade. So what did they do? According to market observers, they flipped, covered their shorts, went long, massively long. Recent COMEX data suggests they're now sitting on approximately 169 million ounces in COMEX vaults alone, which could represent around 40% of total COMEX inventories. In my view, the gap between paper and physical has never been wider. Stage 3 is what I call the break. Something fails. Could be technical, could be political. Suddenly, everyone wants the real thing, the physical asset, not the paper promise. And there isn't enough. And here's what makes me nervous. I think we're watching stage 3 unfold right now. Let me show you what I mean. November 28th, 2025, the CME Group, The exchange handling derivatives reportedly went down due to what they described as a server cooling issue. Reports indicate the outage lasted over 10 hours. During that outage, according to trading data, silver spiked to approximately $56.72 per ounce, an all-time high at that moment. When systems came back online, market observers noted bid-ask spreads were over $1. Now, I'm not a professional trader, but that looks like chaos. That's what illiquidity looks like. That's what happens when a paper market faces stress. Then, just days later, something caught my attention. According to COMEX filings, JP Morgan reclassified around 13.4 million ounces from registered to eligible status. Let me explain why this matters. Registered silver is available for delivery against futures contracts. Eligible silver is just stored there. It's not available for delivery. Think about the timing. JP Morgan reportedly pulled roughly 9% of deliverable silver off the table during peak physical demand. That tells me something. October 2025, market reports showed silver lease rates hit approximately 30% annualized. That means people were apparently so desperate for physical silver, they'd pay around 30% interest just to borrow it. That's not normal. That's what a squeeze forming looks like. December 6th, 2025. Today, silver hits 59.30s. Reports suggest this is approximately a 98% gain year to date, the strongest annual performance since 1980. Stage 4 is what I call eruption. Price explodes, shorts get crushed, institutions positioned early win big, everyone else scrambling. This is where I believe we are right now, and this is where history becomes crucial. Let me tell you about Texas. Two billionaire brothers, Nelson and William Hunt, they looked at silver trading around $6 per ounce and saw something others missed. Inflation consumption exceeding production. A perfect storm. So they bought approximately 200 million ounces, around 1/3 of America's entire silver supply at the time. Then January 1980 arrived. According to historical records, silver hit 49.45. That's roughly 800% in 18 months. Banks panicked. COMEX changed the rules overnight, banned new long positions, forced liquidation only. Silver Thursday, March 27th, 1980. Crash. The Hunts were destroyed. But here's what I think matters most. The squeeze was real, the shortage was real, and the $49 price was real. It literally took changing the entire game to stop it. Now, imagine something with me. What if the buyers weren't two reckless billionaires? What if it was the bank that helps make the rules? That might be what's happening right now. 2008 taught us a similar lesson. Paper mortgage securities collapsed when everyone wanted real assets simultaneously. Historical data shows gold was trading around $720 per ounce in October 2008. By September 2011, it reportedly hit 923, approximately 167% surge. Why? In my view, when paper promises fail, money flows to physical reality. Gold, silver, real assets. And here's what concerns me about 2008. The central banks didn't fix the underlying problem. They just made it bigger. Reports suggest they printed around $16 trillion globally. They bought their own debt, suppressed interest rates to zero, expanded paper markets even further, which brings us to today. Silver is consolidating just below $60. But let's talk about what could happen if it breaks through. According to reports, JP Morgan's earlier projection suggested around $38 by late 2025. We're already roughly $21 above that. Citibank analysts reportedly called for $36 to $39. Those targets have been exceeded. Some independent analysts, like Lawrence Leopard, have mentioned targets of $75 to $90 by end of. But those are conservative numbers. Those assume the paper market holds together. What if it doesn't? Remember the Hunt brothers? Silver hit around $49 in 1980. When you adjust for inflation, that's approximately $170 in today's dollars. We're currently at 59. But consider this. The supply deficit appears worse now. Industrial demand is higher now, and the paper market is exponentially larger now. Historically, silver has tracked gold at a ratio of around 15 to 1. Recent market data shows it's currently closer to 72.1. When that corrects, and historically it always does eventually, some analysts suggest we could be looking at $280 per ounce based purely on ratio reversion. I'm not saying that's guaranteed. We don't need conspiracy theories. We just need what economists call mean reversion. And mean reversion tends to happen eventually. What happens when holders of paper silver contracts demand physical delivery? What happens when they realize there might not be enough metal to cover all the claims? What happens when pension funds, sovereign wealth funds, and retail investors all try to get physical silver simultaneously? That's the scenario that keeps me up at night. December 9th and 10th, 2025, 3 days from now, the Federal Reserve meets to decide on interest rates. According to Bloomberg data, current probability of a rate cut sits at approximately 87.2%. Here's my thinking. If they cut rates, the dollar typically weakens. When the dollar weakens, historically, gold and silver tend to surge. Gold is currently trading around $4,212 per ounce. Some analysts project $4,500 to $5,000 by mid-2026. Silver typically follows gold. It always has historically, but silver tends to move faster, more volatile, more explosive. In my view, the Fed meeting could be a spark. The structural deficit is the tinder. JP Morgan's positioning might be the accelerant, and a paper market under stress could be the explosion. All the pieces appear to be in place. Physical silver is still available right now. Premiums are rising according to dealer reports. Some dealers mention delays, but you can still get it. That window might not last. When the paper market faces stress, when futures contracts potentially can't be delivered, premiums could explode. We're talking possibly 30, 40, 50% over spot price, maybe more. Look at what happened during the 2020 COVID panic. Silver hit around $28 per ounce, but physical coins were reportedly selling for $45. That's approximately a 60% premium. Now imagine that scenario with silver at $100 per ounce. I'm not saying this happens tomorrow, but it's probably not 10 years away either. The Fed meets in 3 days. That's the first domino. Industrial demand keeps rising. That's constant pressure. COMEX inventories keep draining according to reports. That's the countdown clock. When registered silver at COMEX drops below 50 million ounces, and it's reportedly at 113 million right now, the system could face serious stress. At current drain rates, 6 to 12 months, maybe possibly sooner if there's a rush. Here's what I think people miss. This isn't just about silver. Silver is the symptom. The dollar is the underlying issue. Since 1971, when Nixon closed the gold window, the dollar has been pure fiat, backed by confidence and economic strength, but not physical assets. And after over 50 years of printing, 50 years of deficit spending, some economists argue inflation has been masked by methodological changes to CPI calculations. In my view, the bill might be coming due. Gold is at $4,200. Silver is at $59. Energy prices keep surging. Institutional money is flowing into alternatives. The entire market seems to be sending the same signal. Paper currencies face long-term pressure. Scarcity matters. In my analysis, silver might be the most undervalued scarce asset right now. Undervalued relative to gold, undervalued relative to its industrial importance, undervalued relative to money supply growth. When the market corrects that undervaluation, if it does, the move could be significant. In 1980, silver peaked around $50. It took 45 years to break that record. 45 years of what some call suppression, 45 years of accumulation, 45 years of coiling, and now we're here. $59 and climbing. The Hunt brothers were early, they got crushed, but they were right about the fundamentals. Now imagine if they had been patient. Imagine if they had the backing of the entire system instead of fighting against it. That might be JP Morgan today. They learned from the Hunt brothers' mistakes. They're not going to squeeze too fast. They're not going to be reckless. They might just let the market do the work. And when silver hits $100, then $150, then $200, if it does, they'll be positioned perfectly. The signals are everywhere. Record highs, structural deficits, bank accumulation, paper market stress, Fed meetings, geopolitical tensions, all happening at once. That's not coincidence, that's convergence. Stage 1, the setup, done. Stage 2, expansion and debasement, done. Stage 3, the crisis happening now. Stage 4, the inevitable outcome, loading. You don't have to believe me, but you should study history, and history has a way of repeating. I'm not a financial advisor, I'm just someone who's been studying these patterns, watching these markets, trying to make sense of what's happening. The silver situation isn't coming, it's already here. The only question is whether you're positioned to understand what's unfolding, or whether you'll look back in 6 months wishing you'd paid attention. The choice is yours. But think carefully because December 9th is 3 days away. If you want to follow along as this unfolds, hit subscribe. I'll be tracking developments and sharing my analysis in real time as we watch this situation develop. Do you think silver hits $100 in 2026? Drop your thoughts in the comments below. I'm genuinely curious what you all think. This might be one of the most important financial stories of 2025.